All right, so we were just talking about earnings coming up. Big bank earnings are among the earnings coming up. Do they have increased importance because of the lack of economic data that we have, like PPI and CPI and the jobs report? Do you think investors are going to lean more heavily on the commentary from these bank CEOs?
I think we have no choice but to see what they're saying, see what they're seeing in terms of consumer trends with their credit cards, and also looking at kind of, how they're able to kind of manage and navigate the market conditions that we're in. Banks provide a nice little hedge because when things are more volatile, banks will do fine. And if things are actually fine and the consumer's doing well, then they'll make money that way. So, that's kind of a great place to look at. They are the macro.
All right, we're showing some of the earnings estimates for Q3, which we're in right now, Q4. And also, you and I were talking about next year. The earnings estimate for next year, calendar year 2026, is 14% growth. You're saying there's kind of a departure from the data that we have, at least when it comes to estimates for economic growth and these earnings growth. Is that a sign of concern for a market that we already know pretty much is priced to perfection based on the moves that happened on Friday?
Well, I would say yes. Everyone's expecting growth to be really, really strong in terms of earnings, right? But if you look at nominal GDP estimates, which are kind of think of them in terms of revenue, right? How much should a firm make? Well, if you're not doing anything differently and the economy is growing by 5%, you should grow at 5%. So what we're saying is the average firm is going to be able to outpace growth by a factor of 3. That seems a little optimistic, doesn't it?
All right. Well, I mean, I'm asking you. You're saying it seems a little optimistic, actually. I do want to talk to you about AI, because that seems to be really what's spurring a lot of the thoughts of earnings growth. The earnings growth really concentrated in 3 sectors: communication services, technology, and financials. When we're looking at that, the AI trade, the idea that AI is going to enhance margins, reduce the need for workforce to a certain degree, and things like that. You seem to think that people are overestimating the impact. We saw another deal with OpenAI. When we're seeing these deals that seem to be moving the market higher and also pushing GDP, why should investors be concerned? Because it seems like it's all working.
So we're in the investment phase for AI. And what we're not in the phase of just yet is actually we're going to save a ton of money and everyone's going to become increasingly more productive. That comes later. And so I think that there's a disconnect in terms of timing. People are expecting that all the benefits of AI are going to show up tomorrow, right? You're going to wake up and AI will be knocking on your door telling you, you don't have to go to work today, I'll take care of it. And the reality of it is that it takes firms a long time to adapt to new technologies. It takes a long time for firms to figure out how to use those new technologies most effectively. Right? Right now, it saves me time reading some things. That's a time saver, but in terms of a massive productivity boost for me, not really. The real benefit will come when processes can change and AI can actually change the way firms think about doing things rather than how they're doing their current things better.
All right, so you seem a bit skeptical about the near-term real benefit of AI, not the long-term. It seems like you believe in the long-term story, but you say it's going to take some time. So we continue to see these deals that are moving the market higher. Yesterday was OpenAI and Broadcom. I was just alluding to it. Should investors be concerned just about some of the numbers? A lot of people have pointed out OpenAI is expecting to have about $13 billion in revenue this year, hundreds of billions of dollars of deals signed in the last couple of weeks. And they would have to accelerate their revenue just by incredible multiples to be able to pay all these different companies. Now, one of Oracle's co-CEOs yesterday said, of course, they're going to have the money for their deal. But is that realistic? And what happens if we don't see some of these deals materialize as they're currently laid out?
Well, I mean, without regard to any specific company, you just have to be mindful of kind of how people are making these deals, how people are signing deals. And that's true of any industry, right? Think about it. If this was any other industry, how would people be responding to some of this news? And I think the answer is to be a little more cautious. And I think whenever there's a build out of new technology, you have to be mindful of the fact that you might be building in the wrong direction. I think the example of the Chinese AI firm that came out and had supposedly a different model, and it was much less energy intensive, and all of a sudden, then the market went in a completely different direction because they're like, oh wow, maybe we got this wrong, and I think it always behooves investors to think, how might I be wrong, and if I am wrong, exactly how does that play out?
Okay, what about this commodity rally we're seeing in recent days since the government shut down? Gold's hitting new records, but also silver, copper's rallying, palladium, platinum's rallying. What does that say about the global economy? What does that say about investor sentiment that before Friday we're seeing the market hit new highs, and at the same time we're seeing commodities rally?
So I think there's 2 things. One is there's the whole China international relations, let's see how that plays out. The other, though, is Fed credibility. So gold is rallying pretty dramatically and outpacing gains in equities, right? Which is telling you that people prefer real assets to financial assets. Why would they do that? Because they're worried that the Fed's not going to maintain a credible stance on inflation and growth.